Kapoor is here with us now. Anshu, good afternoon. Thanks so much for your time. Anshu, give us a flavor of what kind of conversations are you having with your clients right now? I'm assuming most of their portfolios must be mildly to bit in the red, given that October, November, bulk of the portfolio would have peaked out. Are they perturbed, most of them, the big HNI community? Are they waiting for further decline patiently to buy? What's the sentiment like?
Right. Hi, Ajay. Good afternoon. Great to be with you. Yes, there's been a bout of volatility that clients have to contend with over the last couple of months, and it's not been easy. Obviously, the most critical question everyone is asking is, have the conditions changed? What does this Fed tapering mean for India now? How does it impact the market? How does it impact the economy? So I think those questions have come up. But at the same time, I must say that unlike earlier bull markets where a lot of leverage would get built out in the system, fortunately for us right now, the leverage is not there. Actually, I would say it's fairly low. So therefore, there is no pressure on positions or clients to sell, their positions if there is a sharp downturn or a volatility in the market. So therefore, there is comfort, there is confidence, and there is fair amount of conviction that India is fairly well positioned in today's environment. So I'm not seeing or sensing any kind of panic. On the contrary, we are getting questions on, okay, tell us where and what to buy. So it's overall quite positive, I must say, Ajay.
Levels are they sitting on right now? Are they bulk of them fully invested, or have they raised, or have they, in consultation with you, raised their cash levels? And where are the interest levels now coming for deploying money?
Yeah, definitely. So we can talk about markets and we can talk about asset classes as well, Ajay. I think broadly there is fair amount of cash available in the portfolios. There was some profit taking by our customers, and obviously last year was watershed in terms of returns. So there has been profit taking, and there is a little bit of a reshuffling based on advice that we are giving out to customers in terms of their stock positions or thematic positions. For example, we are right now overweight fairly well on banking, and some amount of positions are shifting from IT into banking or even into telecom and industrials. So there is a little bit of shuffling that will happen in the portfolios. That is mostly on the equity portfolios. On other asset classes like fixed income, there is very little to choose from, and clients are demanding products that can give a little bit higher yield. And finally, I must speak of this. There's a huge demand in private markets. And, if I may take a couple of seconds on this. So there is this belief that our Nifty will transition, or, the new economy will enter Nifty and the other indices that we have. And therefore, there is demand for products or solutions that give access to India's new age companies that will very soon hit the market. So there's a lot of demand for late stage private equity in, per se, venture debt, venture capital, and so on. There's a new asset class that has come up, I must say, over the last couple of years.
Anshu, let me ask you, slightly uncomfortable question. Surely this new asset class is making many of them feel FOMO, fear of missing out, and it is understood as well because it's got complex technology at work at many places. How are you navigating the risk of getting your client community exposure in this new economy class at unsuitable prices or unsuitable valuations, be it in the private side or right pre-IPO or even at IPO? Bulk of them, because entry price do matter, entry valuations, they do matter, don't they?
Yeah, absolutely, Ajay. I completely agree with you. Price is the only thing that matters. Finally, you can buy a great business, but if you pay too much for it, you may not end up making too much money. So definitely, having said that, for us, the recommendation to clients has been to go through high quality funds. There are a lot of high quality funds available now, including a few funds that we are managing. And these funds have proven to be resilient and proven to be selective while coming to investing. And yeah, valuations are a parameter. So therefore, do not get carried away. First of all, do not get lured into doing single stock transactions yourself because you do not have all the information. If you own a very minuscule amount in a $1 billion company, you do not have any right to information. So what I'm trying to recommend to investors is that there are a lot of these unlisted securities available on a transaction by transaction basis. So perhaps look at a fund. That is recommendation one. Recommendation number two, look at the evolution or the size or the life stage of the fund. Obviously, when you are entering a very early stage, the risks are higher. But whereas if you are choosing a fund that only invests in mature or grown up startups, so to speak, your risk is lower, right? So that is the second recommendation I have. And the third is look at the investment strategy of the fund. There are a couple of themes, Ajay, that are very visible to us, and they will play out very beautifully over the next 3 to 4 years. And if it's okay, I'll talk about a few. For example, the whole electric vehicle revolution. India will become world's largest two-wheeler electric vehicle ecosystem. No doubt about that. So perhaps look at something like that. Look at clean energy. We have a huge roadmap for clean energy. So that is something I recommend. Third, maybe health tech, digital tech, agri tech. So there are these 4 or 5 large big themes, that I can talk to you about piece by piece, but do not get carried away by, like you said, FOMO or this is a structural story. So this will be available to us for the next 5 to 10 years. So there's no rush, and go with a fund manager who is in no rush to deploy. I completely agree. Valuations may not be at the best levels right now.
Mm-hmm. Anshu, what about the fixed income part of the HNI portfolio with rates turning higher? Last few years, the focus completely has been on equities, but how is the fixed income part doing, and what are you recommending on that side?
So our recommendation, Ajay, there is obviously to wait until you try and lock in yields in traditional fixed income products. But there are a couple of products that are available and allow you to lock in good yields and IRRs, and namely real estate investment trust and InvITs, infrastructure investment trusts. So there you can get on a pre-tax basis that the REIT will give you about close to 6.5 to 7% with potential of some appreciation. So, and that is very liquid. And similarly, InvITs will give you a higher pre-tax and with liquidity. So do not lock in your liquidity right now is the recommendation. If rates are trending up, let's wait and watch before we add duration. So till now, stay in what you call accrual products or hold to maturity products. But I think as rates go up, more opportunities will come for clients to lock in. So therefore, just keep it simple right now. Look at some of these products for kickers and with liquidity. And let's see how this evolves, because we do not know what will be the pace of tightening followed by both the Fed and the RBI. So that we need to see.
Mm-hmm. And lastly, Anshu, how is the interest in overseas equities, mainly US? Last 1.5 years, that has also become almost a fad. So many funds launching their versions of US exposure in various manner. But then there has been a very reasonable correction, especially in tech, in FANGs and all. Has it dented the demand for US equities among your HNI portfolio or not yet?
Yeah, definitely. And thank you for asking this, Ajay. And I've said this to you earlier as well. I think Indian customers need to diversify. That is point number one, because 99.9% of our investors and all the wealth is tied to India, Indian rupee, and the 4 or 5 asset classes in India. It makes a lot of sense to diversify in the other 97, 96% world market cap. So that is point number one. And if you see the flows over the last couple of years now, this whole international investing and through the mutual funds and the ETFs is about 50,000 crore market size. And if I'm not wrong, 70% of that money has flown in the last 2 years. So there's some opportunistic money, but I would still advise a systematic diversification and investment into the global markets. US is the largest market, definitely yes, but there are other markets as well. So go out and diversify, but make it that it's a strategic diversification and not an opportunistic ploy. That is one. And I think there are a lot of themes that are still not listed or available in India. Like I just mentioned, the EV theme or their blockchain or deep tech or robotics or automation. Some of these things are not available in India yet. And therefore, if you believe that these are sunrise themes, now a lot of products are available to you to kind of look into these themes and maybe build some portfolios as we go along and stay with broader markets. So be broad, as in be with the index, maybe to begin with, select high quality ETFs to begin with, and then go narrow into these themes or stocks. Because if you are at a stock level, you will see a lot more volatility. Nifty, Nasdaq, for example, had a stellar run last year, but it's only down 10%, right? So from peak to trough, it's only down 10%. It's something that you can stomach. But if you get into very small stock level themes, you may get hurt a little bit more. So just be careful, but diversify uh, certainly.
Right. All right, Anshu. Great chatting. Thanks very much for your own
Thank
inputs
you.
this afternoon.